Hello. Um, we are here today to go over how to estimate the value at risk. We're going to start. This analysis by saving your spreadsheet for portfolio analysis and port evaluation, and you'll just come up here and do a file, save as, and save it as a different file name. I've called mine VaR1. You can call it anything that you want. All right, so I'm here with the portfolio weights, portfolio evaluation, portfolio plot, and the portfolio returns. And what we're going to do to start with is create a VaR analysis based on trading days. Okay, so this is a simulation to find out what the worst possible or the worst case scenario is based on actual trading days that have occurred. So I'm just going to go and insert a tab, and this is what we ultimately want it to look like, and this is how we're going to set it up. And I'm going to do the setup for the Sharp Optimal portfolio and then leave it to you for the minimum variance portfolio. So organization is always good. We're going to start with runs, and it's just going to be the 1 day. Call it run 2. So we're going to start with a simple 1, 2, 3, 4, 5. And ultimately we're going to do 500 runs, but I'm going to use the drop and drag methodology to fill out this whole analysis. I'll run 2, 1, 2, 3, 4, 5. So the idea here is that we're going to create 500 simulations of 1 day's worth of trading. And we can do that pretty simply. We're going to use the equal sign, come over here to our portfolio weights and set the initial value, which is $200,000. And then we're going to multiply that by our portfolio return for the Sharp Optimal. You notice this is the last day of my analysis. So what it means is in one sample day, it's possible for me to get a $888 return on my portfolio. We want to keep the portfolio weights constant, so we'll go up here and hit, the portfolio value constant. So we'll hit F4, so that always stays at $200,000. And then we're going to drag this down. That's going to represent our different potential return values. So this day, simulated day, represents random day draw of a negative $1,788. This is minus $2,400. This one plus $1,300. This one plus $7. And now what we want to do is highlight all 3 of these columns and go ahead and drag down. Now we're starting in 3. We want 500 simulations. So we'll drag down here to around 503. I think it should be actually 502. And here our count is 500. So on the 500th day simulation, we lost $655. On 496, we actually gained 2398. So as part of VaR, we're looking at the 1% probability of the most significant loss. And we have 500 simulations here, so the top 5 loss days represent the value at risk that we're interested in, the 1%. So the next thing we want to do is go ahead and order these, sort our daily returns from lowest to highest. So from the most negative number to the most positive. And the sort function starts, if I start in this column and move over, we're going to sort on column B. If I start in column A and move over, we're going to sort in column A. So we're already in order here. So what we want to do is start with column B, type 1, top 1, rotate over, slide over, and then down through our entire list of 500 simulations. And then I'm on the Home tab, so I'm going to come over here to Sort, and smallest to largest. So my worst possible day of these 500 days was minus $7,558. And my fifth worst day, number 5, is it's 4,000, minus 4,122. So the VaR calculation is pretty straightforward. Our 10-day VaR is simply going to be equal to the square root, SQRT, of 10 days multiplied by the loss. So this is the 1% loss. Losses 1% probability, because there's 500 simulations, so 1% of 500 is 5. So our loss is going to be at least, with a 1% probability, at 4,122 or worse. And we're going to move that over 10 days. Move this into dollar values. So the 10-day VaR represents $13,037. Now, the textbook is going over the value at risk from a standpoint of a bank or a mutual fund, a large institution. And that selection of 10 days is a function of potential losses that are out there, a sequence of 10 days, and the ability of the company to raise capital. Obviously, for a large bank, it's much easier for them to raise capital than for an individual. So for an individual, we're usually going to look at a 60-day VaR. 60 days is 1 quarter. There's 20 trading days in a month on average, and therefore 3 months, 1 quarter would be 60 days. And that is the amount of time that an individual might need in order to go ahead and raise significant capital. So their value at risk is a longer term because it takes more time in order to raise capital to cover your losses. And here we're just going to say it is equal to SQRT. Instead of 10 days, it's now 60 days. And we're going to multiply that by, again, our 1% loss. So the 60-day VaR for the Sharp Optimal portfolio is $31,935. So as an individual, I might look at a 60-day value at risk because as my portfolio starts dropping, it's costly for me to adjust the portfolio. It costs me $10 for every trade, for example. Where large institutions, you're looking at pennies per trade. And a large institution can raise capital. They can go to the Fed, for example, the open window at the Fed, and borrow $100 million overnight or for a couple of days to survive short-term downfalls, where an individual it's going to be more difficult. They may have to go and do a home equity loan, sell some different things, or save some money, borrow against IRAs, other things, which are definitely going to take longer, and hence a quarterly VaR. So that's the basic premise here, is that we have taken 500 days, in each actual trading day, we simulated it as a 1-day event. So on day 369 of the simulation, we ended up with a negative $7,000 loss plus, but on day 71, it was minus $2,800. Okay, So you'll do this for each of the portfolios. This is the Sharp Optimal. If you highlight those guys, you merge text and go to Sharp Opt. And then you'll do the same thing again for the minimum variance portfolio. So this is what we're looking for. Our 10-day value at risk, our 10-day value at risk, and our 60-day value at risk. You'll need to do the 60 days for obviously both portfolios. All right, so that's a start. This is the over, there's a 1% probability, 1% chance over a 10-day period of losing at least $13,000 in my Sharp Optimal portfolio, and on the minimum variance portfolio it's $11,922, and over 60 days it's $29,000. Okay. So the next thing that we want to do is create a downside risk curve. So here's a plot of a downside risk curve. The probability is here on the Y, and our potential losses are here on the X. And you can interpret this a couple of different ways. It's a cumulative probability. So as we move to the right, our probability increases. So if I pick a value like 0, there is basically a 44% probability of having a day be a negative return. But there is also if it's 45 negative, there's a 55% probability of having a given day be a positive return. Another way that you use the downside risk curve is when you suppose you wanted to add some additional stocks to the portfolio, what you want to have happen is to have this curve shift over towards the right. So it decreases the probability of negative days while increasing the probability of positive days. If you add additional risk to the overall portfolio, it stretches this curve out, makes it flatter, so the curve here becomes less and things string out a lot farther. Higher chance of positive returns, but also higher chance of negative returns, where by shifting this curve, what we're trying to do is actually shift the mean, make the mean a little bit more positive. Okay? Now, in order to generate this, we're going to use the frequency function. So here's an example. Now we've sorted our variances by, we've sorted our losses from negative to positive. So in terms of selecting the bins that we're going to pick here, we're going to use the fact that we sorted them to go ahead and pick the value. So this is the 5th worst day in the analysis, and therefore it's VaR 1 B7. So here's VaR 1, here's B7, number 5, that's the 5th worst day. So that bin will be everything from 4122 and less. The next bin that we selected is bin number 15. So we go back here to the VaR tab, VaR 1 tab, we go down to 15, and there's our 2,842. So we're simply taking this and setting it equal to, come down to our VaR sheet, and 15. Okay. Continue through here. I've picked 35, 75, 150, etc. I have 10 bins, which gives me 11 buckets. My cumulative probability is going to be obviously 100%. In your process, I want you to pick more than 10 bins, no more than 20, so anywhere in between 10 and 20, over 10 and up to 20 would be a good selection. And then we're going to use the frequency function. So this is what it looks like. You'll notice it has the brace on either side, and that's telling you that this is a array function. So in order to do the array function, we're going to highlight the entire list. So we want 11 buckets from 10 bins. And then we're going to type in it's equal to FR, and that's going to give us our frequency. The next thing is the data array. So we'll come here to VaR tab 1 and we're selecting our list of returns. Hit comma. And then we're going to come over to select our bins. And we're going to pick the bottom one down here, not picking the last bin. You hit parenthesis to close it, and then don't hit enter, hit Control Shift Enter. And it'll go ahead and count the number of observations in each one of the bins. Now this is nice. These numbers right here would be difficult to explain to a customer, for example. But now that I've got this set up, I could set this value instead of minus 2842, we could just say minus 2800, and it'll recalculate the bin. And this one might be minus 2200. Nice round numbers, which makes it easier for everybody to understand the process. And that's the advantage of using the frequency calculation. That is automatically going to adjust based on what bin I select. And the next thing we want to do is calculate the cumulative probability. Now, because we have these guys organized this particular way, we can calculate it as A2 divided by 500. Remember, there's 500 simulations, so 5 of them are going to be in the 1%. And then here we're going to do 15 because we have 5 plus 10. An alternative way to do this calculation, leave this one the same, or actually what we can do is say is it is the sum of A2 through, or I'm sorry, C2 through C2. Parenthesis, and we're going to lock this first in with an F4. So it's saying we're always going to start on C2 and then we're going to add everything that's below it. So now we can drag this guy down, and it is the sum of 5 and 10. And this one here is the sum of 5 through this number 50. Now in terms of selecting your bin sizes, we're interested in the downside risk, so typically smaller bin sizes on the loss area. You let them get bigger as you get in the middle, and then you decrease them again as you get towards the end of the cumulative probability. Alright, the next thing we want to do is go ahead and create a plot, a downside risk curve that's going to look similar to this. To do that, I'm going to start by highlighting my percentages, cumulative probabilities. Come over here to insert, and I'm going to insert a scattered plot with the curve. So here's my chart. I'm going to go ahead and click on the select data, and I'm going to edit the series. So my Y values are going to be the percentages, my X values are going to be my bins, and this is the cumulative probability function. Alright, so this is similar to the other charts. You can move chart location, which allows you to create a new sheet out of it, easier to work with. And then go ahead and label your axes. Like this one goes up to 120%. There's no such thing as a probability more than 100%. So we can just set this at 1 and hit return. So our nice cumulative probability, again, 45% is basically where we're at for the negative side and positive side. If we take this point right here, that's around 95 percentile. It says right there 95 percentile. So that means there's a 5% probability of having a return greater than $2,500 in a day, but equivalently a 95% probability of a negative return less than that. All right, that's our downsize probability. And now that is based on, again, the simulation of actual trade data. The next way we can calculate value at risk is based on modeling. So one of the things that we did by generating our analysis of the portfolio is that we came up with, I look at portfolio weights, portfolio volatility, okay? And in our portfolio evaluation, we have an actual daily volatility, but what we're more interested in is the expected daily volatility. All right, I believe I'm recording again. I had to pause. My daughter came home and was making noise. Anyway, so from the portfolio evaluation, we want to use our expected daily volatility. So what we're always looking for on value at risk is the volatility. We'll make the assumption that is a normally distributed. So in VaR 2, what we're looking for is the expected one-day volatility. This is from port evaluation C10, port evaluation C10, expected volatility. And then the one-day loss is simply the 1% critical value, which is 2.326. So this is 2.326 standard deviations away from the average, which is going to give us our loss. Now, we're going to assume that the average return is in fact 0 per day. And on a daily basis, that's not too bad, because the daily returns are typically quite small. And then the cash value of a 1% probability loss is going to be portfolio weights, C7, or in other words, it is 200,000 times the one-day loss, or it's going to be $5,597. So that's pretty close, actually, to our VaR 1 calculation of, open this up, of minus 4,122. So this is based on actual trading data. This is based on the statistical distribution. Standard deviation with a mean of 0. We multiply the standard deviation by 2.326 to get the 1% loss. Again, assuming an average daily return of 0. We multiply that loss by the cash value of the portfolio, $200,000. You get 5,967, and then we multiply that again by the square root of 10 to get our 10-day VaR. And we've done this based on, this is the predicted values, and then we do the exact same thing based on the actual values that we've come up with. So in expectation, or prediction would have been a VaR of negative 17,700 roughly. The actual value at risk that stood out there was 11,503 over our portfolio evaluation period. Now, I do this to let you understand that there's a difference between the theoretical calculation of what your value at risk and what it actually may end up being. In this case, it's lower, but it could also be higher. And then we do it again for the minimum volatility portfolio, minimum variance portfolio. Our expected one-day standard deviation comes from port val 10. So expected one day, and we just rounded up. It's basically 1%. Multiply it by our 2.3, multiply it by the cash value, multiply it by the square root of 10, to get the 10-day VaR and our actual values over here. And that represents the modeling approach. So modeling approach can give you either more or higher VaR values, or it can give you less when compared to the simulation using actual trade data. It's just a function of what the market was doing over the previous 500 days, and it has been trending up significantly over that time period with short periods of corrections that have gone through. So that's it. That's the entire process of doing modeling. Let's get over here a little bit farther. Another thing that we want to do in terms of the analysis is what's known as a stress test. So a stress test is a little bit different in that we're not just going to consider a 1% probability. What we're going to consider is that this is going to be the worst 10 days in a row that you can imagine. So the data-driven stress test here is really straightforward. We're just going to sum, okay, just the sum. We go to VaR1, and we're just summing the worst 10 days in a row. So we lose 7,000 the first day, 4,800 the second, etc., etc., etc. These are 10 consecutive days of the worst possible losses. And the total is 36,559. And that represents the stress test of the portfolio. If things really, really go bad and you have a continuing degradation of the market, a market crash, over 10 days you may be expected to lose as much as $36,000. From a model stress test, we're going to do something a little bit different. I'm going to go ahead and insert a new tab. All right. And the standard deviation in the portfolio, which is coming from the evaluation, go over here to Port Evaluation C13, and that's the expected daily, or this is the actual daily volatility, or you can do it based on the expected daily volatility. And in fact, you're going to be required to do it based on both. So what we want to do, though, is we're going to create a random number generation based on just the standard deviation. Now, this is the actual standard deviation, or we can do it based on the expected standard deviation. So I'm going to do it based on the expected standard deviation in this one. So this again is our sharp optimal. And we'll merge that together. This is the standard deviation, and I'm interested in the 1-day standard deviation. So it is equal to our expected daily volatility, okay, which is similar here. We're going to have our run, our return, and our loss. So run, RTRN, loss. So the run is going to be, again, 1 through 500. And we don't necessarily, for the simulation, this Monte Carlo simulation, need 500, but we can work with it. It's just matches. We could do 1,000, we could do 100, we could do 10,000. It doesn't matter. Here we go. 505, 500. And then what we want to do is use the random number generator to create a random list of our random selection of potential returns. So that's under data, data analysis, and we want to do random number generation. And we want one variable, which means it's going to be one column. If I would have picked 10 variables, it would have created 10 columns. We want 500 random numbers, representing 500 days. And it's going to come from a normal distribution. The mean is going to be 0, but the standard deviation is 0.012032. Okay? And our output range here. Well, not quite what I was looking for. Go back again. Random number generation. Output range. Oh, sorry. Click on output range there. Output range is this guy. And again, we want one variable, 500 random numbers being generated, and our standard deviation. We'll click OK. So next thing we want to do is go ahead and sort these guys. Come back to the home page, and we sort them from smallest to largest. And just use without the expanded selection. Alright, so these are the worst possible days that are out there. And our loss is going to be the portfolio value times 1 plus the rate. And then we're going to compound that loss as we go through. So this is 10 days in a row of really bad returns. You'll notice that these returns, like this one is minus 0.2, that's because it's a random number generator. And it's also because we've started with a different standard deviation in this random number list. So if I ran the number, if I did multiple random number generations, I wouldn't expect the same series to be in each one. Alright, so this is then equal to our portfolio value of 200,000 times quantity of 1 plus that return. So that's how much I lost the first day, and then the next day I'm losing against this value. Okay, so as we show here, our second day's loss is the previous day's ending value times 1 plus today's loss. Okay, so in this case we're going to go here, and it is equal to previous day's ending value multiplied by the quantity of 1 plus our loss. And then we can drag this one down through 10 days. And then our value at risk, our 10-day VaR, is then going to be equal to our portfolio value that we started with minus the accumulated loss. And we actually want the negative of that. So we started with $200,000, and after 10 really bad days, we end up with a loss of $50,000. And this represents the 10-day stress test VaR. Okay, worst case scenario based on the model. So it's just based on the standard deviation the daily standard deviation that comes from your portfolio. We're going to add these guys together to find out what the worst of the worst case scenarios are. Right, and this is not unreasonable. When the market crashed, this is your return. Let me just go ahead and calculate that. The return is the ending value minus 200,000. That's 2 million. And that's parentheses. And then we're dividing that again by 200,000. So it's a minus 25% loss. A little over 25% loss in 10 days. In the 2008 market crash, that's about what you got. In fact, by the time the market completely crashed, you're looking at over a 50% loss. We went from around 14,000, close to 14,000 in July. By March 2009, we were around 6,000. Right, so over a 50% loss in 5 months. Which talks in terms of the true value at risk that you have. All right, so once again, the VaR for the model, you create a random list of random returns from the random number generator. Sort those returns so that from smallest, most negative to most positive. And then you're going to calculate the running loss if you have the worst days possible, 10 days in a row. And then take your portfolio value, 200,000, minus the ending value, and take the negative of that, and that becomes your value at risk, 50,000 bucks. Okay? And then for the database stress tests, we've already sorted it. We're just going to sum those 10 bad days in a row, which gave us a data stress test of minus 36,000. So you'll do that for the sharp optimal portfolio, the minimum variance portfolio, and you'll do it based on the actual standard deviation that you measured over the evaluation period, as well as the standard deviation over the expected standard deviation from when we built the model. All right, so when I see you in class, hopefully you'll have all this taken care of. We'll go over it in class and then spend a little time talking with regard to the report that's required for it. Thank you very much. Goodbye.